Now, my market wrap guest says today it's a nagging worry that the U.S. Federal Reserve might take that punch bowl away sooner rather than later. Diana Avigdor is Vice President, Portfolio Manager, and Head of Trading at Barometer Capital, and she's at the TSX today. Diana, good to see you again.
Thank you very much.
I've been told March. You don't think it's going to happen in March?
No, I hope it's March. I'm just saying that if it does happen sooner, it's the one event that the market is underpricing.
Okay.
And we have some very serious data coming out next week. So from a trading perspective, I'm looking at everything is looking excellent. Market is looking great. Valuations are in line. We have U.S. consumer doing well. We have financials doing well, which is a pillar of our equity system, and we like to see financials doing well. So I'm looking forward to the risk. Next week, we're having some jobs data, and we're having same-store sales, which is going to give us a glimpse into Black Friday, which is this Friday, and maybe even Cyber Monday. So all those indicators as to the health of the economy will give us the last data points that go into the December 18th FOMC meeting. And there's only about a 30% possibility or expectation that there will be a taper. And we've seen this movie before where the market has expected something and we got something else.
We've been using the phrase a lot lately, so much so we're getting complaints. Melt up as far as the market. Speaking of melt up, look at the S&P 500. They're up 27% in the last year. How much of this has to do with high-frequency traders inching the needle forward bit by bit?
I don't know. I don't think that it has to do with high-frequency traders. On a day-to-day basis, there's different kind of high frequencies. There is opportunistic high frequency, but there's also electronic trading. All of our market structure has changed, and it's all electronic now. A lot of times you have high frequency referring to algorithmic electronic trading, but who's behind that is not necessarily traders that are looking to take advantage of, say, a real buy order or a real sell order. The markets have done well for very fundamental reasons, being that risks were taken out of the market, companies are doing better, it has been a multiple expansion story. So certainly there's been some very fundamental reasons the market's up as much as it is.
And when we even look at it from the lows in June, the financial services sector, by example, is up 13%. How do you feel about the banking group that's responsible for the gains we did see today?
So I think that in terms of what investors are looking for, despite the fact that we've had some very good markets, I think that investors' risk appetite and demographic situation still wants them to look for stocks that pay out a dividend, steady, dividend growers, companies. Our financials have gone through, the Canadian financials, have gone through several thematic changes in the last 6 to 9 months. For example, we've had global investors coming out of the financials, the Canadian financials, and having one of the shortest bases in a while we were talking about a few months ago, because they were expecting that our housing market was going to crumble the same way as it did in the US. Well, that didn't happen. So all of that came back. These banks, we're going to have some new data points next week. But generally speaking, our market has done very well. They're tracking GDP. They have EPS growth rates and revenue growth rates, and they're dividend growers as well. So it all ties in. They have asset management, which because of the better equity markets are doing very well. Mutual fund flows are positive. So several things are working for the financial, as well as fee increases last quarter.
Diana, good to have you with us. Thank you so much.
Thank you for having me.
Diana Avigdor is Vice President, Portfolio Manager, and Head of Trading at Barometer Capital Management.